Okay, y'all, I've done another PowerPoint called Options Contract Decision Making, Understanding Risk. This is super important if you're going to be investing in the stock market and trying to make some money or just preserve your capital, get some type of return on investment. This educational presentation will prepare you to make choices by identifying the riskier versus the less risky factors. And understanding of these risks that are associated with options contracts will help you decide whether the reward is worth the risk. I want you guys to utilize these risk parameters that'll be on the following slides to structure your trades with the risk that you're comfortable with. So you should be able to sleep at night with a clear mind when you have trades on. You know, if you're afraid of a big loss or something, or, you know, you should definitely close the trade because it can literally stress you out, mess with you mentally. And that's the last thing you want to do when you're trying to manage your money. The more systematic and mechanical you are with your trading by following a set of parameters or rules, the easier it's going to be. And you'll be able to run it like a business when you stick to those rules. So, but also if you don't, I put a little caveat in there, if you don't want to close the trade right away, you don't want to listen to me, then you can add a leash called a trailing stop. In Tastyworks, it's called a stop market order or stop limit order. And that just helps so that the loss doesn't get out of hand. But when you submit any of these orders, it's your declaration to the stock market that you're willing to lose around that price that you specify. But you're saying that that's about the most I'm willing to lose. But, you know, only when you place that order can it be, you know, potentially fulfilled or executed. So if you don't place the order, then your position is not just going to go away unless it expires, of course. So you got to be mindful of expiration dates. But yeah, when you place your order, you know, the market can see that order price. No, they don't know that it's you. But if your order price is close to what the option price is, well, the stock price is currently trading at, there's a greater chance of your loss order, you know, that stop market order, stop limit order being fulfilled or realized pretty early after you set it. So let's go to the next page. All right, so we're gonna get into lowering your risk and subsequently your reward, because risk management is about putting the controllable factors in your favor. So let's get into some of these controllable factors. To lower your risk and reward, that's all this video is going to be about, lowering your risk, which subsequently lowers your reward as well. I'm not going to do a video for a little bit about increasing your risk because people are just getting started, especially on my channel. So one of the first things that you can do to lower your risk is choose a further expiration date. The reason why is because it gives you more time to be right. Simple, right? So if we go to how can we do this on Tastyworks? When you're on the platform, you're going to click the plus time button under expirations when you're editing your trade. Another thing you can do to lower your risk is choose a ticker symbol with a beta at or below 1.0. The reason why is because if it's below 1.0, that symbol generally fluctuates less than the broad market. And that, in other words, it's not moving around a whole lot. It'll move, but it's not moving around quite as much as the broad market, specifically the S&P 500 index. How do we do this on Tastyworks? You're going to use the left sidebar, create a watch list, add the symbol, click the 4 lines after the activity tab, and go to your watch list. And you'll use the gear to add beta to the list of displayed columns. You'll have columns on that page on your tab when you're on your watch list. So when you buy, here's another thing that you can use to lower your risk. When you buy or sell to open a position, just do a low quantity or just do one. The way that you do that, from the trade tab after selecting your strategy, just adjust the quantity. That's how you do it on Tastyworks. Another thing you can do to lower your risk is to invest in an ETF. Of course, check its beta, that's already above, and not an inverse or amplified ETF like TQQQ. And when I say amplified, that means that it's multiplied from what the market actually does. Its beta is probably going to be high if it's calculated correctly on your platform. I don't invest in it, so I don't even know what its beta is. I'm just guessing what it should be. Or you can invest in an index ETF. I highlighted this because these are super important. They are they fluctuate a lot less than an individual stock. We're getting into the why now. That means they're less volatile because the ETF's price movement isn't isolated to just one ticker symbol. It's a multitude of them. It's a bunch of them. So one way that you can find ETFs, I don't want to say the only way, but this is one way you can find ETFs. You can go to ETF.com, literally search the company that you're interested in and find ETFs that contain that company. But what you want to do is use Tastyworks liquidity meter to determine if it has options that are worth trading. Why do I want you to check its liquidity meter? Because it's easier to get a good price when you're opening or closing a trade when the ticker symbol is liquid. It's easier to get in and out of a trade a lot quicker because it's more heavily traded. The bid price and the asking price are not that far apart. So you want to have any type of trade that you make it, you want it to be in a pretty liquid symbol. The way that you can add liquidity symbol, it's the same as adding beta on Tastyworks. Go to the watch list, go to the displayed columns, and just add liquidity. And 4 stars of liquidity is considered the best on Tastyworks. So here's the last page of my short list. There's actually more things than this, but I just wanted to keep my video fairly short, and I feel like I'm getting close to time, so I'll try and hurry up. You want to check your probability of profit on every trade. We're going to unpack that real quick. If you're buying an option, choose a strike price that's in the money or close to where the stock price is currently trading at. For example, if you have a call option, if you're buying, remember we're in buying right now. If you're buying a call option, pick strike prices that are below the current price or at the current price. If you're really, you should do it below. But for put contracts, pick strike prices that are above or at the current price of the stock. And that's if you're buying, spending money to open a trade. If you're selling an option though, choose a strike price that's out of the money or far from where the stock price is currently trading at. For call options that you sell, pick strike prices above the current price. And for put options, pick strike prices that are below the current price. The cool thing about Tastyworks is this is another displayable that you can put in your columns, just like beta from the previous slide. So just add POP to it. When you're reviewing a trade, when you're about to open a trade on Tastyworks, they also show you the probability of profit before you fully press submit. So that's pretty cool about the platform as well. You want to trade, and Thinkorswim does the same thing, but I imagine if you're on this video, you might be, have a small account and have watched my getting started with a small account with Tastyworks video. But another thing you can do to lower your risk, and this is how I teach beginners to trade, is to trade vertical spreads. And a vertical spread is you basically buy and sell, either 2 call options or 2 put options. So you're going to have 1 bought call and 1 sold call, or 1 bought put and 1 sold put at the same expiration, at the same time, all in one transaction. So the cheaper of the 2 calls or puts will essentially help finance the other, or it caps or limits your risk and reward. That's what we're trying to do here. We're trying to lower our risk. We want to sleep at night when we have these trades on. But it also helps determine whether your trade will be a buy, which is a net debit, or a sell, which is a net credit. For example, if you bought or debited option costs less than the sold or credited option, those 2 options together, which is a spread, results in a sold or a net credit position because the bought one costs less than the sold one. That's how you know if you did this or structured your trade right for the spread, because you can have a bought vertical spread, which is a debit spread, or a credit spread, which is a sold spread. So net credit means you sold it to someone else. You collected money to open the spread, and a net debit means you bought it from someone else. You spent money to open the spread. So that is it for this video. Sorry if I went over time a little bit, but no fluff here. That's it. Hope this video helps somebody. Thanks for watching.